I want to tell you about a graveyard. Curious? Not a dark one, not a dramatic one, just a drawer, in a bedroom, in a house somewhere in the suburbs. Inside that drawer sits a collection of silver that took 14 months and roughly $3,000 to build. And it is worth significantly less than what was paid for it. Not because silver crashed. Silver is trading near $85 an ounce as we speak. Not because the person who built it was stupid. They are actually quite smart. They research everything. They read forums. They watch videos. They believe deeply in the thesis. Size. The graveyard exists because belief without structure is just expensive enthusiasm. The person who built this drawer, let us call him Marcus, made 8 purchases over 14 months, 8 receipts, 8 decisions that each felt correct in the moment and each quietly cost him in ways he never anticipated. Today, we are going to walk through every single one of those receipts. We are going to calculate the damage down to the dollar where we can. And then at the end, I am going to show you what the exact same budget spent with the right architecture would have produced instead. The gap between those two outcomes is not small. And in a market where silver costs $85 an ounce, that gap is growing wider every single year. Let us follow Marcus. Quick disclaimer before we start. This is education, not financial advice. Marcus is a composite character built from real patterns I have observed across years of conversations with real buyers. Prices are approximate and reflect current market conditions. Always do your own research and consult qualified professionals before making any financial decisions. Receipt 1. February. Marcus buys the wrong product from the wrong place. Marcus discovers silver in February. He has been reading about the dollar. He has been reading about deficits. He has been reading about inflation eating away at savings accounts that pay almost nothing. And he decides he wants something real, something tangible. Something that does not depend on a bank's promise or a government's competence. So Marcus goes online. He types "buy silver" into a search engine. And the first result is not a reputable dealer. It is a marketplace listing, a private seller. Reviews look decent, price looks reasonable. And Marcus, without doing any further research, buys 2 1-ounce silver rounds for what seems like a fair price. The rounds arrive. They look fine. They feel heavy. Marcus puts them in his drawer feeling satisfied. Here's the problem. Those rounds came with no receipt, no documentation of the purchase price for tax purposes, no recognized mint stamp that a dealer will immediately trust at resale, no certificate of authenticity, nothing that establishes provenance. When Marcus eventually takes those rounds to a dealer, the dealer will look at them, test them, and offer him melt value minus a credibility discount, because the dealer cannot verify what they are looking at without spending time and money on testing, and dealers price that uncertainty into their offer. Marcus saved perhaps $3 per ounce buying from an unknown private seller. He will lose $8 to $12 per ounce when he tries to sell. The cheapest silver on entry is almost never the cheapest silver when you calculate the full round trip cost. Damage. Approximately $20 to $30 on a small purchase. The real damage is the pattern it establishes. Marcus now believes that price is the only variable that matters when buying silver. That belief will cost him far more in later receipts. Receipt 2. March. Marcus discovers silver coins and loses his mind a little. March arrives, and Marcus has been watching silver content online. He has seen the coins, the beautiful, detailed, limited edition coins, the ones with the dragons on them, the ones commemorating historical events, the ones that come in velvet boxes with numbered certificates and mint packaging so elegant it feels like holding a piece of art. And Marcus buys one. $78, 1 ounce of silver, dragon design, certificate included. At the time, a standard 1-ounce silver eagle, the most recognized, most liquid, most dealer-trusted silver coin on the planet, was available for approximately $92. Wait, Marcus's coin was cheaper, so Marcus made the right call, right? No, and this is the mistake that trips up more new buyers than almost any other. Marcus's dragon coin carries a private mint numismatic premium at the point of purchase, a premium the broader silver market does not recognize. When Marcus bought that coin, he paid for the art, the design, the limited edition branding, and the velvet box. When Marcus tries to sell that coin to a dealer, the dealer will offer him melt value, because the dealer cannot find a retail buyer willing to pay a premium for that specific private mint design. The collector audience for any individual private mint series is tiny and unpredictable. The Silver Eagle, by contrast, carries a sovereign mint premium that the market recognizes universally. Every dealer, every buyer, every coin shop on the planet knows exactly what an eagle is and what it is worth. That recognition has real monetary value that shows up at the point of resale. Marcus paid $78 for something the dealer will offer him $70 for. He paid $92 for an eagle, the dealer will offer him $87 for. The eagle cost more, the eagle also returned more. Because in silver, what you pay at entry only tells half the story. What you receive at exit tells the other half. Damage: $20 to $30 in unrecoverable numismatic premium. More importantly, Marcus has now established a habit of buying based on aesthetics rather than liquidity. That habit is about to get significantly more expensive. Receipt 3. April. Marcus panics and buys at the worst possible moment. April brings a headline. Actually, April brings 17 headlines, all screaming the same message. Silver is going to $150. The industrial deficit is accelerating. There is a squeeze coming. Get in now or miss it. Marcus's co-worker mentions silver at lunch. His brother texts him an article. A YouTube video he watched that morning said, "This is the moment." And Marcus, flooded with urgency and surrounded by noise, goes online at 11 p.m. and buys 15 ounces of silver in a single transaction, at what turns out to be the exact monthly peak price. We have seen this pattern play out repeatedly in 2026. Silver hit $121.60 on January 29th and dropped 25% the following day. The buyers who rushed in at that spike learned an expensive lesson about the difference between urgency and timing. Marcus did not rush in at a 25% spike, but he bought at a local monthly peak that corrected $6 per ounce within 10 days. On 15 ounces, that is $90 of completely preventable damage. Preventable not by being smarter, not by having better information, not by predicting the correction. Preventable simply by spreading the purchase across 3 weeks instead of doing it all in one emotional night. If Marcus had bought 5 ounces per week for 3 weeks, his average cost would have been $3 to $4 per ounce lower than his single panic purchase. Same conviction, same outcome, less damage, just patience. Urgency is one of the most expensive emotions in the silver market, and the market knows exactly how to trigger it. Damage: approximately $90 in timing premium, running total across 3 receipts, roughly $130 to $150 of preventable loss in just 3 months. Receipt 4. May Marcus buys a large bar because it looks impressive. By May, Marcus has been building his stack for several months. He has coins, rounds, and a growing sense of confidence. He goes online and discovers kilo bars, 30 to 15 ounces, lower premium per ounce than anything he has bought so far, heavy, impressive, real wealth you can feel in both hands. Marcus buys one, approximately $2,850. Here is what Marcus did not think about. That kilo bar is now a single indivisible block of $2,150. Marcus cannot sell half of it in an emergency. He cannot gift 5 ounces of it to his son. He cannot liquidate a portion of it when he needs $400 quickly. He cannot use it for a partial exit if silver spikes and he wants to take some profit while holding the rest. The kilo bar is efficient on the way in. It is inflexible on the way out. The same $2,850 spent on individual 1-ounce coins or 10-ounce bars would have given Marcus the exact same amount of silver with complete modularity. He could sell 1 piece or 10 pieces, depending on what his life required at any given moment. Silver's practical value is not just its spot price, it is also its usability. And usability requires denomination flexibility that large bars simply do not provide. Think of it this way. Imagine your entire savings account held in a single denomination that cannot be broken into smaller amounts. You would never do that with cash. Do not do it with silver either. Damage: no immediate dollar loss, but a liquidity trap has been set. The moment Marcus faces an emergency or a partial exit opportunity, the kilo bar will either cost him a significant dealer discount to break or force him to sell more silver than he actually needs to. Receipt 5. June. Marcus buys silver he cannot insure or document. A friend of Marcus has a friend who is selling silver privately. No dealer markup, no shipping, cash deal. Price is 14% below current dealer rates. Marcus buys $600 worth of silver rounds and bars in a bag with no packaging, no receipts, no mint identification, and no documentation whatsoever. This seems like a bargain. Here is what Marcus actually bought. He bought silver he cannot insure, because insurance requires documentation of what you own, what it cost, and where it came from. He bought silver he cannot easily sell, because when he takes those undocumented pieces to a dealer, the dealer has no way to verify their purity without testing every single one and no way to represent them to retail customers as anything other than generic melt material. He bought silver with a gap in his cost basis records, which becomes a problem at tax time because Marcus has no documentation of what he paid and no proof of when he acquired it. And perhaps most importantly, he bought silver that he cannot fully verify himself. The pieces are probably genuine. Most private sale silver is. But without proper testing equipment, Marcus is relying on trust rather than verification. And trust is not a strategy in a market where sophisticated counterfeiting of silver products does exist. The 14% discount Marcus received on entry will show up as a 14% or greater discount at exit. The credibility gap he accepted when buying follows the silver everywhere it goes until it is melted down and recast by a recognized refiner. At which point, the silver has changed hands multiple times, and Marcus has lost the premium savings he thought he was capturing. Damage: approximately $60 to $90 in exit discount on the private sale silver, plus unquantifiable insurance exposure and documentation gaps that create ongoing risk. Receipt 6. August. Marcus discovers silver futures and loses a month's salary. By August, Marcus is feeling confident. He has been in the market for 6 months. He has read a lot. He has watched a lot. And he has started to believe he understands silver well enough to not just own it, but trade it. He opens a futures account. The leverage in the futures market means Marcus can control a large position with a relatively small margin deposit. He puts in $1 on $200 and controls a position worth significantly more. Silver moves against him, not dramatically, just $3 per ounce in the wrong direction, but because of leverage, that small move wipes out a significant portion of his margin. He gets a margin call, he has to put in more money or close the position. Marcus closes the position, he has just lost $400. Here is what no one explained to Marcus before he opened that account. Futures are not silver. Futures are contracts about silver. They expire. They require active management. They carry overnight risk. They operate with leverage that amplifies both gains and losses. They require a level of market attention, technical knowledge, and emotional discipline that is completely different from physical ownership. A person who is good at understanding why silver's long-term thesis is strong is not automatically good at trading short-term futures contracts. These are entirely different skills, and the market charges tuition to anyone who confuses them. Physical silver rewards patience. Futures punish it. Damage: approximately $400 in direct trading losses, plus the psychological damage of a significant loss that makes Marcus question his entire thesis, not because the thesis was wrong, but because he applied it in the wrong vehicle. Receipt 7. October. Marcus liquidates his emergency fund into silver. October comes and silver dips hard. Marcus has been averaging down. He believes in the thesis. He has read everything. He is convinced this dip is temporary and that silver is heading significantly higher. And in a moment of total conviction, Marcus transfers his entire 3-month emergency cash fund into silver. Every dollar. 0 liquid reserves, full silver position. 2 weeks later, his car needs a major repair. $100. Marcus has to sell silver, not because silver went down, not because his thesis changed, but because life happened and he had no cash buffer to absorb it. He sells silver at a price $8 per ounce below where he bought it in that final October purchase. On 20 ounces, that is $160 lost to a forced sale, a sale that would not have happened if Marcus had maintained even a modest emergency fund. This is one of the most painful and most common mistakes in precious metals investing. It is not a failure of the silver thesis. It is a failure of financial architecture. Silver is not a savings account. It is not instantly liquid at the moment you need money. It requires a willing buyer, a transaction, a time delay, and acceptance of whatever price the market is offering at that specific moment, which may or may not be a good price. Cash reserves exist precisely to prevent you from being forced to sell assets at times and prices not of your choosing. Eliminating them in favor of any single asset, no matter how strong the thesis, is not conviction. It is dangerous overexposure. Damage: approximately $160 in forced sale losses, plus the broken thesis confidence that comes from selling silver at a loss not because you were wrong, but because you were underprepared. Receipt 8. December. Marcus stops paying attention entirely. By December, Marcus is exhausted. The volatility, the headlines, the conflicting information from people who seem equally confident in completely opposite directions. The forums arguing about whether silver is going to $200 or back to $20. The constant noise. Marcus decides he is done paying attention. He will just hold and wait. He stops checking the market. He stops reviewing his position. He stops tracking the forces that are actually driving silver prices in 2026. And this is his final and perhaps most quietly damaging mistake. Because the silver market in 2026 is being driven by specific, trackable, meaningful forces. A sixth consecutive year of structural industrial deficit. Ongoing tension between paper pricing and physical availability. COMEX inventory levels that have been making headlines all year. Energy sector demand that is genuinely accelerating. Central bank behavior that has direct implications for precious metal valuations. None of these forces are hidden. All of them are trackable by anyone willing to spend 20 minutes per week staying informed. But Marcus has checked out. So when silver moves significantly in the first quarter of next year, Marcus will react emotionally rather than structurally. He will either panic sell at the bottom of a correction or chase a spike at the top, both of which we have already watched him do in earlier receipts. Ignorance is not peace. Ignorance is vulnerability, wearing a calm expression. A silver holder needs a minimum information diet, not obsessive daily price checking, not 12 newsletters, just 2 reliable sources, a monthly review of the structural signals, and a clear understanding of what would actually change the thesis. Without that minimum awareness, Marcus is not a strategic silver holder. He is just someone with a drawer full of metal, hoping the world cooperates. Damage, no immediate dollar loss. But every future decision Marcus makes will be worse because of this knowledge gap. And in a market driven by structural forces rather than random noise, the uninformed investor always ends up on the wrong side of the move they could have seen coming. The total damage report. 8 receipts. 14 months. Approximately $3,800 spent across all purchases. Direct measurable losses. Wrong sourcing on receipt 1. $20 to $30 numismatic premium on receipt 2. $20 to $30 panic buying timing on receipt 3. $90 private sale credibility discount. $60 to $90. Futures trading loss. $400 forced sale at bottom. $160. Total direct damage approximately $750 to $800. That is roughly 20% of Marcus's total silver budget gone to completely preventable errors. Not market losses, not bad luck. Structural mistakes that architecture would have eliminated entirely. And then there is the structural damage that does not show up in today's numbers but will appear at the worst possible moments. The kilo bar that cannot be partially liquidated. The undocumented silver that cannot be insured. The eliminated emergency fund that forces future asset sales on the market's schedule rather than Marcus's. The knowledge deficit that guarantees emotional reactions to future moves. The rewind. Same budget. Same 14 months. Same conviction about silver. But every receipt done correctly. January and February. Instead of unknown private seller rounds and a private mint-proof coin, Marcus buys recognized sovereign mint coins from a reputable, established dealer. Silver eagles or silver maples. Products that every dealer on the planet will recognize instantly, buy without testing, and offer fair market value for. Fully documented. Full receipt. Cost basis established from day 1. March. Instead of panic buying 15 ounces in a single emotional night, Marcus sets a simple rule. Maximum 5 ounces per week. He buys 5 ounces per week for 3 weeks. He captures prices across the range of the month rather than at the single worst moment. Average cost is $3 to $4 lower per ounce. On 15 ounces, that is $45 to $60 saved with zero additional effort. Just patience operationalized into a simple rule. May. Instead of a kilo bar, Marcus buys 2 10-ounce bars from a recognized refiner. Same total weight. Lower premium per ounce than individual coins, but each bar is independently sellable, insurable, and transferable. Modularity preserved at no additional cost. June. Marcus walks away from the private sale entirely. He pays the standard dealer premium, receives documentation, gets a receipt, and builds a clean provenance record for every piece he owns. August. Marcus does not open a futures account. He stays in his lane. Physical silver for long-term wealth preservation. If he wants market exposure beyond his physical stack in future, he researches ETFs with full understanding of what they do and do not provide. He does not confuse trading vehicles with investment vehicles. October. When silver dips, Marcus buys from his monthly discretionary budget only. His emergency fund remains completely intact. When his car needs a repair in November, he pays it from cash without touching a single ounce of silver. His thesis is uninterrupted. His position continues working on his schedule. December. Marcus maintains a simple information routine, 2 sources, monthly position review, clear understanding of the 3 or 4 structural signals that actually drive silver pricing. He is not obsessed, he is informed. And the difference between those two things is the difference between reacting to the market and understanding it. Same money, same metal, same thesis. But a stack that is organized, documented, modular, credibly sourced, properly sized within his total financial structure, and built on architecture rather than impulse. The gap between Marcus's actual drawer and this corrected stack, approximately $750 to $800 in direct losses recovered, an eliminated liquidity trap, full insurance coverage on every piece, a clean cost basis for tax purposes, and a position that serves his actual life rather than threatening it when things go sideways. The 8 rules, extracted from 8 receipts. Rule 1, always buy from recognized, reputable dealers. The cheapest price on entry is not the cheapest price when you calculate the full round trip. Credibility has monetary value that shows up at the exit. Rule 2, buy bullion when you mean bullion. Reserve numismatic and collector premiums for a small dedicated layer of your stack, not the foundation. Aesthetic value and resale value are different things. Rule 3, never let urgency set your timing. Spread purchases across days or weeks. Dollar cost averaging is not a compromise. It is a structural advantage that removes the most expensive emotion from the equation. Rule 4. Keep denominations modular. 1-ounce coins and 10-ounce bars provide the right balance of efficiency and flexibility for most buyers. Impressive large bars make poor financial tools. Rule 5. Document everything. Every purchase, every receipt, every cost basis entry. Undocumented silver cannot be insured, creates tax complications, and commands lower exit prices. Documentation costs nothing and protects everything. Rule 6. Stay in your lane. Physical silver for physical goals. If you want trading exposure, learn trading before you trade. Confusing vehicles is one of the most expensive mistakes available in this market. Rule 7. Silver is a layer in your financial structure, not the structure itself. Maintain cash reserves. Maintain diversification. Concentration kills the thesis by forcing exits at the worst possible times for reasons that have nothing to do with silver. Rule 8. Maintain a minimum information diet, 2 reliable sources, monthly review, understanding of the 3 or 4 structural forces that actually drive the market. Informed is not obsessed, uninformed is not peaceful, it is exposed. 8 rules, each one free. Each one learned the expensive way by thousands of buyers every single year, each one preventable by 25 minutes of video before opening your wallet. Marcus did not need to lose $800 and 14 months of compounding mistakes. He needed architecture, a plan for what to buy, in what form, at what pace, from what source, in what proportion to his total financial picture, with what minimum level of market awareness. Architecture is free. Mistakes compound. And in a market where silver is trading at $85 an ounce, the cost of those mistakes has never been higher. Drop a comment below. Which of Marcus's 8 receipts have you seen before, either in someone you know or in your own buying history? Drop the receipt number. No judgment here. Identifying the mistake is the first step to never repeating it, and this community gets smarter every time someone is honest about what went wrong so someone else can avoid it. If this video saves you even 1 receipt's worth of damage, hit the like button, subscribe, and turn on notifications. New content posted weekly. Share this with someone who just started buying silver in 2026. Give them the 8 receipts, give them the 8 rules. Give them Marcus's 14 months in 25 minutes so they do not have to live it themselves. Marcus's drawer exists somewhere right now. Do not build one like it. Same budget, better architecture, different outcome. Build the right stack.